Corporate decisions play a powerful role in moving stock prices because they directly shape a company's future earnings, risk profile, and investor confidence, which are the fundamental drivers of valuation in financial markets. Investors do not simply react to what a company has already achieved. They respond to what they believe the company will earn and become in the future. And corporate decisions are the signals that guide those expectations. One of the most influential areas is earnings and profitability decisions, such as cost-cutting initiatives, pricing strategies, or operational expansions, because these actions affect margins and cash flows, prompting investors to reassess growth potential and adjust stock prices accordingly. Strategic decisions like mergers and acquisitions often lead to immediate and sometimes dramatic price movements, as investors evaluate whether the deal will create long-term value through market expansion or technological advantage, or whether it introduces risks such as excessive debt, cultural mismatches, or integration difficulties. Capital allocation decisions are equally critical, including how a company chooses to use its profits, whether through dividends, share buybacks, debt repayment, or reinvestment into growth, because these choices reveal management's confidence in future cash flows and their priorities for shareholder value. For example, a share buyback can signal undervaluation and financial strength, while aggressive dilution through new share issuance may raise concerns. Leadership-related decisions also move stock prices, as changes in the CEO, CFO, or board of directors can signal either renewal and improved governance or instability and strategic uncertainty, leading investors to revise their outlook. Corporate communication plays a significant role as well, since earnings guidance, forward-looking statements, and investor presentations shape market expectations. And even small changes in outlook can cause price volatility if they diverge from what investors anticipated. Decisions related to financing and balance sheet management, such as taking on additional debt or restructuring liabilities, influence perceived financial risk and resilience, affecting how investors value the company during different economic conditions. Investment in innovation, research, and development can boost stock prices when markets believe it will create sustainable competitive advantages, but may also pressure shares in the short term due to higher costs and uncertain returns. Corporate actions tied to regulatory compliance, legal risks, and ESG practices increasingly impact stock prices, as governance failures, lawsuits, or ethical concerns can trigger sharp selling, while strong sustainability and transparency practices attract long-term institutional investors. Operational decisions, including supply chain changes, market exits, or shifts in business focus, can also move stock prices if they materially affect revenue stability or growth prospects. Ultimately, stock prices move not merely on current performance, but on how corporate decisions reshape expectations about future earnings, risk, and long-term value creation. Because financial markets are forward-looking and constantly reprice companies, based on the signals management sends through every major decision.